It's a lot going. Well, while people are coming in right now, why don't you put in the chat just to verify you here? You see the screen titled Current Updates to the Employee Retention Credit. That would help me a lot just to know. Yeah, I got a chat coming in, so hopefully that's a good sign. Yes, you're hearing. All right, we're still got people coming in, but I'm going to get this going just so we get everything in because there's a lot to cover today. So welcome everybody to another Tri-Merit webinar series. Today, we are going to be talking about current issues with the Employee Retention Credit, which there's quite a few issues out there with the Employee Retention Credit. Probably been a year, I'm guessing, since we did our last ERC webinar. We had done quite a bit, but you know, it came to our attention that people are clamoring for information still, and so I think it's important that we talk about this today. A little bit of housekeeping before we get going here. I want to just mention to everybody that, you know, I wasn't going to bring this up today because we have our conference that is starting Monday, but we still have people registering right now. So I just put a link to the conference in the chat if anybody wants to get more information. But starting Monday in Chicago, you know, jump on a plane, drive to Chicago, join us. I think today's the last day to register, but take a look if you want to come. We're going to have a really cool conference in Chicago next week. And I put that in the chat if you want to get more information. All right, so with me, let me just go back real quick. I seem to have lost one slide, but we'll talk about that slide. We are doing this for CPE, obviously. If you want and need CPE, you have to stay logged in for 50 minutes. You'll have to answer 3 of the 4 polling questions that'll pop up during the presentation. We'll let you know. They're not going to be randomly. We'll let you know they're popping up, so just answer them. Just a warning, if you are logged in through a website to Zoom rather than the Zoom app on your computer, you may have the polling questions get blocked by your pop-up blocker. So disable the pop-up blocker. If you still aren't seeing these, and we used to get this, you know, a year or 2 ago quite a bit when people logged in. I think most people have the app now, but if you are not seeing the questions, the polling questions pop up, put your answers in the chat and we will make sure that you get credit for your CPE. Your certificates should go out within 3 to 4 days. I'm going to preface that with our conference next week with probably thousands of certificates being mailed out. We might be a little bit slowed down on these certificates, but you will receive them, you know, hopefully within the next week. It'll go to the email address you registered with. Often what we see is that email address, maybe somebody doesn't get it, but it goes to spam. So check your spam and make sure you get your certificate. And if not, you still don't see it, then reach out to us and we will get it to you. So with that being said, let's jump on. You see live and in person, and you see their pictures. Nick and Haley with today. Nick and Haley have been on the ERC team from the beginning. You know, we started this 2.5 years ago. Wow, is that what? It's more than 2.5 years ago now. We started this ERC team. Haley's in charge of the team, senior director, and then Nick is our CFO and partner with Tri-Merit, and he has been very active on all things ERC as well. So it's been a great team, and we've probably dealt with a lot of you in the past, and thank you for that. It's been fun, but there's a lot of things that are not fun these days. This is what I do. I just go out and present on things. That's my bio. I'm not going to go through that. I do want to give you a quick update on, you know, Tri-Merit, just because, you know, ERC is something that we did, but that's not something we started as. We've been around for 16 years. We you know, help the tax advisor by being an extension of their advisory team and allow you to bring all kinds of different credits and incentives, tax saving opportunities to your clients. Couple things that I want to point out on that is there's a huge new one, which you're going to be hearing more from us. We've done a little bit of webinar on this, but the renewable energy tax credit. This is credits, I should say. There's multiple credits. This was defined or enhanced in the Inflation Reduction Act. Watch for this because the opportunity is right now projected to be over 10 times the R&D tax credit opportunity. So this is a big one. We'll put more information out on that. And then one thing I don't have in the slides, but it's going to be pertinent to our discussion today, is we have a new service that Haley is also heading up, and Nick part of as well. We're getting lots and lots of requests for second opinions on ERCs, because there's a ton of misinformation out there. And so we've started a new service where we're going to give a second opinion on a client's ERC, to give you one peace of mind. Yes, you can put this on the tax return, or no, you cannot put this on the tax return. And we'll probably have one of 4 outcomes there. This was good, go forward. This was completely wrong, return everything. This was partially wrong. There's more money due, or there's less money due, or everything was perfect. So this is a service we're going to put out. Reach out to us if you have any questions on that. I'm not going to go deep into that today, but it may come up. All right, big thing that we're going to talk about today is IRS information that has come out recently. IRS has talked about the supply chain issues with the employee retention credit. They put out a memorandum or a notice on that. We're going to go into that. They've also had some additional notices and informational bulletins and everything recently. They told us a year ago they were done putting information out on ERC. Well, with everything that's going on out there, they were not done. So we got additional information. So we're going to expand on that today. One of the biggest things is going to be supply chain. And unfortunately, we're going to basically tell you that none of your clients are going to qualify under supply chain. And we're going to tell you why, and we're going to tell you why IRS agrees with that as well. And this is something from day one that we have been saying, that supply chain is almost impossible to qualify. That's the information we'll go through today, give you a little bit of an agenda, but overall, it's ERC. And what I'm going to do is just start with some basic, let's go back to square one. What is ERC? Because we're hearing so much information out there that ERC is this and ERC is that, and you can qualify this way, that it's really not nearly as complicated or as broad as people are making it sound. There is very succinct ways you qualify. And I get called, emailed, text, even Teams messages, LinkedIn messages, everybody telling me I qualify. And you all do too, and all of your clients do. And that's why there's so much confusion. And the things that you hear, I'm going to go on a rant here for a second. I told Nick and Haley there's a good chance I'll go on a rant at some point. So I'm going to go on a rant here for a second. You're going to hear things like, the biggest question they ask your client is, okay, did you have any supply chain issues? And immediately everybody says yes. And then they're going to tell them they qualify. We're going to debunk that as we go today. You're going to hear things like, well, did you send people to work from home? Oh, you qualify. No. Did you put up plexiglass? You qualify. No. Did you reduce hours on your own decision? You qualify. No. You're hearing all this misinformation. So let's get to the bare facts of what really is true. And we have a ton of guidance. This lists all the guidance we've received since the CARES Act came out in March of 2020 until the most recent information on the supply chain and the growing risk IRS is seeing that came out in the last month. So there's been a lot of information out there, and we can refer back to those. Back to basics. Defined in 2020. Big thing there is PPP and ERC couldn't survive together. That changed at the end of 2020 when the Consolidated Appropriation Act came out. What you're hearing now is people are saying, I get an email every day. I got one yesterday. Oh, the qualification requirements for ERC have completely changed. You most likely qualify now. There's been no change. The only change that happened was at the end of 2020 when they decided that ERC and PPP could coexist. Not coexist from using the same dollars, but you could do both. That was really the only major change that came out. Now, there were some additional definitions that came out after that, but from a qualification standpoint or a quantification standpoint, that was really the only change that occurred, was the end of 2020. So if you hear major changes out there, they don't really exist. But we did have things like, the American Rescue Plan that extended the ERC, all the way through the end of 21. We know how it works right now. 2020, there was a credit. 21, there's a different qualification for a credit. We'll go into those. In addition, there's a recovery startup business qualification that was defined in the American Rescue Plan. That's the only businesses that could qualify in the fourth quarter of 21 for a long time. All businesses could, or for a while, and then that got pulled back. So that's the only one that can go there. And then one thing I want to point out too, just be aware, and you've heard this, I'm sure, but they extended the audit period to 5 years for the last 2 quarters of 21. This was in the American Rescue Plan. Some people think it's all quarters. The way I read it, it's only the last 2 quarters of 21. And Nick, Haley, I don't know if you agree with me on that. Yeah, just the last 2 quarters of 21 is the 5-year statute. What happens with this, though, if you have a client that claims an ERC in one of those quarters, they get it audited 5 years down the road, find that they have to return all this money, that statute of limitation on amending that tax return has already run. So now they're going to get a double whammy. They're not going to be able to amend that return and get take the expenses back on that return, and they're going to owe this money back. So you got to be very careful that you do a very strong analysis on all your clients' potential ERCs. All right, and then we already said the fourth quarter got eliminated for everything but an employee recovery startup business. All right, so first thing, let's go into this notice that came out in March of this year, where IRS is talking about what your responsibility is filing tax return. And Nick, do you want to expand on this?
Sure. So a lot of pretty much the IRS and the AI CPA both kind of confirm this, but there's a lot of fear working with your clients who bring obviously claims to you that you don't know if it's legitimate or not. What the notice essentially says, if you can't reasonably conclude that they were qualified for the claim, then you should not prepare a return. So it's all around Circular 230 and doing your due diligence as a preparer. So some people have thought like, I absolutely cannot file a thing for my clients. If you have good reason to believe with your clients that the claim is, properly claimed and adequate, yes, you can sign off it, do your due diligence, ask the right questions, make sure that they are qualified, which we'll cover some of the things to ask on this slide. But the biggest thing is to know that the IRS is essentially stating we will be holding preparers accountable if they are not doing due diligence and just pushing through ERC, amendments that include an ERC claim if they're not asking the proper questions.
All right, and with that, I am going to put up the first poll. So everybody pay attention. First poll is going up. I just launched it. So if you didn't see it, your pop-up blocker may be blocking it. So answer in the chat, but hopefully you're all seeing this. We have quite a few people on. So I'm going to leave this up for a minute, but if you have any clients that claim ERC after you told them they do not qualify, and this is a common occurrence, we see this quite often. We know we've worked with a lot of tax advisors, tax preparers, where we've gone on calls and told the client they don't qualify. And then we've heard after the fact that, well, someone else told them they do qualify and they went and claimed the credit. And this is exactly then what Nick was just talking about. Now, what's your responsibility with that client? And I've had more than a handful of tax advisors tell me they've had to part ways with clients because they won't listen to their advice on this. And it's just a bad situation. So, yeah, I'm going to leave this. We have 91% of you are participating in the poll. I'm going to end it because we're right at a minute. So we have 59% of you saying no, which is great, but 41% saying yes, you have somebody claim this afterwards, which is high. That is a big percentage. So this is why this is a big deal. At this point, you have clients that unfortunately are not taking your advice. And now if you don't agree with that, you just see what Nick said on what the responsibility is. You have to decide how you're going to handle this. All right. And then IRS came out with another recent release where they're talking about all the fraud that they're seeing is going on. And Nick, I'm going to throw it back to you on this too.
Yeah. So this one came out at the end of July, I believe, is when this release came out. But it was pretty much all about the fraud going on. There's throughout the presentation, we're going to highlight a bunch of different quotes from this article and address how you should be looking at things and how it applies to you. But pretty much, we're all seeing that these companies out there are trying to lure people through lots of different ways. They'll say things like the supply chain, they'll say things like CDC qualification, they'll say a bunch of different ways to try to say you're qualified without really digging into the situation. And they're aggressive about it. I mean, like Randy said, we've seen everyone's, if I had to bet, every single person that's on this meeting or this webinar has gotten an email, cold call email saying, did you know you might be qualified for
I
$26,000 per
don't even
employee?
own a business and I get them daily.
Yeah.
So, yes.
Yeah, so they're not marketing to specific people or clients. They're just spraying this out everywhere in hopes that people sign up. So that's the very first thing. If the marketing is aggressive, it's coming in without any type of conversation with the client around what they do or anything like that, saying they're qualified. That's the first red flag to look for, and we'll go into many others.
Yeah, and I'm seeing some questions in the chat just regarding if the CPA did not file the 941X and a third-party preparer filed that. Questions surrounding if it's still on the responsibility of the CPA because that income tax amendment has to be filed. The answer is yes. The AICPA and IRS has provided guidance on that because you have to accurately depict the expenses in the tax return, the income tax return. It is on the responsibility to make sure that what you're recording is accurate in a thorough analysis. And Nick, I don't know if you have anything else to add on that.
Nope. Yeah, I mean, if you're not doing the claim, as preparer, we know that there's certain things we could take as fact from clients when they let us know things, but you do have to ask the right questions. You can't just not ask questions and take their claim at face value is what they're saying.
Right, which puts the tax preparer in a little bit of a catch-22 because, okay, now I know I need to amend this return, but I'm told I can't amend this return. And so now I know that this income is incorrectly stated. So it's a problem. And unfortunately, it's a problem you're all being put in. In addition, when you do see these, whatever, I think everybody's calling them a mill, but these aggressive companies out there pushing ERC, they're leaving out a lot of key details. They're not talking about how PPP interacts. They're not talking about other incentives interact. I mean, R&D tax credits interact. All these different credits can interact, and they're not talking about that. They're often not talking about how the income tax effect. They're basically saying this is a tax-free benefit. It's not a tax-free benefit. There is an effect to the income tax return as well. And so they're all this stuff. So if you hear that stuff, you all know, but if you hear this stuff, and there's this stuff your clients are hearing, at least you can bring up this information to them. Like, hey, there's a false statement right there. Let's be a little weary of going any further with that. All right, so let's go into the basics real quick, and then we're going to get into the supply chain because that's going to be a key thing we talk about today. I think supply chain will be after this, but let's talk the basics. This is straightforward, honestly. There's a safe harbor rule, and this is I'm going to expand on this for a second because there's a safe harbor rule. If your clients had this drop in revenue, and we all know this, 50% drop in any quarter in 2020, and that's a quarterly effect, 50% drop compared to 19, or 20% drop in any quarter in 21 compared to 19. Now there's some caveats. If we have 20% drop in the fourth quarter of 20, it pre-qualifies the first quarter of 21. Overall, this is the safe harbor. It doesn't matter the reason the drop was there. Honestly, it's a safe harbor rule that qualifies. So that's really probably how a majority of your clients, a big chunk would qualify. But there is the secondary, government shutdown rule. And this is the one that gets gets a lot of misinformation out. Again, this is fairly straightforward. I mean, we do this all the time, but it's straightforward from a standpoint that was I fully or partially shut down due to a government order, a government mandate that directly affected me, my business, and the easiest example here, and if you try to get more complex than this, you may be going outside the boundaries. The easiest is restaurants. Restaurants were closed almost universally across the country at some level from a capacity standpoint. Some completely closed, some from a capacity. They could still deliver, they could still have curbside pickup, they could still, have drive-through window open, but the indoor. That's a partial shutdown. Restaurants almost universally can qualify at least for that period. So that's what you should be thinking about when we're thinking about a government shutdown. Now, there's also, where places were shut down completely. Maybe we had a dentist's office for a month. They were told they can't see anybody. That's a full shutdown. And so those types of things. Now, there is this more than nominal effect that I'll talk about in a second where, we can prove a partial shutdown through math and analyzing the shutdown rules. But here's the math of why, how you qualify. This is where the 26,000 comes from. It's up to 5,000 per employee in the year 21 as a year, basically March 13th till the end of the year. It's up to potentially 7,000 per employee per quarter in 21. A lot of these mills are qualifying everybody for 6 quarters. And there's almost no businesses other than with a drop in revenue is going to qualify for 6 quarters. So that 26,000 per employee, that's far and few between. You're not going to see that just because it's so difficult to qualify for every quarter, especially when we're talking mandates. Mandates, stopped. I personally am in Illinois, and the last mandate that I know of was June 11th of 2021, 22. Haley, would you remember the date? Yeah, that's right. It's so my math, my dates are, I have COVID brain from the standpoint I can't remember any dates anymore. But it was 21. Yes, June 11th, 21 was the last date there was any mandates that I know of in Illinois. And Illinois went long compared to
June
a lot of
11th.
states.
Yeah.
Yep.
You're right.
So,
June 11th. Yeah.
So be very wary if your client's being qualified for every quarter. Again, the math just shows you why this is such a big thing being pushed, because the dollars grow fast. Just with 10 employees, the potential's there for 260,000. We talked about the safe harbor already. This is easy way to qualify. Easy from a standpoint, you can back it up, you can support it, you can do math. Math is pretty easy, no matter what everybody thinks. Math is pretty easy, and we can figure this out. The 20%. The one thing that they don't talk about too when they're looking at qualification is, okay, what's the interplay with other things? What are gross receipts? What are not gross receipts? This is just a list here. You're going to have these slides. These are going to be mailed out to you. But if you're doing a gross receipts drop, a lot of times they're not taking into account everything. And so make sure you take into account everything. And the basis to figure out the gross receipts drop is a income tax basis. So whatever basis you're using for income taxes is the drop. Doesn't matter if your financial statements are on accrual and your income tax is cash is what we use. If it's vice versa, it's whatever the income tax return says. And Nick, there's some complexities around. This is another area that is being missed a lot when you're talking about the mills, but there is this aggregation rules. Do you want to expand on this?
Yeah. So when you're looking at aggregation in the gross receipt scenarios, people have asked us before, well, we have one company that started up late in the season of looking at 2019, 2020, and 2021 comparably. Well, unfortunately, if it's part of an aggregation group, you got to count that as $0 quarters, and it counts as part of the aggregation group during the time they were in existence. So if you're a company where you're in existence, we've seen it where companies have been impacted, their gross receipts of their individual company dropped. However, a second company was started that was part of their aggregation group, and because of those new gross receipts, they didn't qualify. The IRS has been pretty clear that in the guidance that you have to take the control group as a whole. So you had a new company that starts up, it increases gross receipts. Unfortunately, that can act as a way to disqualify you because those extra gross receipts you didn't have before. So if everyone's in existence for the full time period, you just use the regular quarter. If they're not in existence for all of 2019, then you have to prorate the gross receipts for the quarter, and they use that as a comparison until the quarter is possible. So what that means is if they started in, let's say, Q3 of 2019, that's what it says, that Q3 becomes the base period for Q1 through 3 of 2020. However, for 2021, you would then use 2020's numbers if there was not a quarter in 2019 that were in existence. It's a bit confusing. It's easier to see kind of written on paper. But what you essentially need to know is if something was in existence all of 2019, you carry back, the gross receipts to the time period when they did start during 2019. When looking at 2020, 2021, you're just comparing to 2020 if there was not a 2019 quarter available, and then follow those same rules. As far as if you have new businesses, right, there is some arguments that I've seen people make. Okay, is the new business an extension of the existing business, or is it a completely different business? Can you put those things together separately? These are things people have asked. We don't have very specific guidance on whether you can separate it out if it's not related to the existing businesses. But the conservative thing to do is say, yes, it needs to be all aggregated as a control group. The bigger question is probably around whether something can count as a recovery startup business if it's part of a control group when it's a completely unrelated business starting. So those are a couple of, even at this stage, kind of unanswered questions, but we always take the conservative route and say, hey, you're going to have to count as part of the control group, and that's going to kind of disqualify it from recovery startup, and going to have to count as part of a full group. It could disqualify a gross receipts drop.
Yep. All right, I'm going to skip that. I wanted to talk about the more than nominal, and thanks, Nick. Hey, in the meantime, you know what? I'm going to put poll number 2 up. So let's start poll number 2. Give me a second. We're going to launch poll number 2 right now. And you should see it on your screen now. Have any of your clients qualify for ERC under supply chain disruption? I'm curious on this because I'll give you some stats from us here in a minute, and Haley can confirm my numbers when I tell you. I'll tell you, and then she'll confirm if I'm right or not. But we've got only 87 of you. I want over 90% of you to participate in this before I close it out. We're only 30 seconds in, but we're at 89. So get your vote in, or get your poll answered here so that you get your CP. This is poll number 2. So remember, make sure you answer 3 out of the 4 polls. We're over 90% now. So I'm going to close this poll, and I'm just going to let you know, I'm not going to show you, but at this point, we are 87% no, which is good, but 13% saying they have had clients qualify under supply chain. So we're going to talk about supply chain here in a second, but I'll tell you our numbers at this point, and I'll probably have the dollar figures wrong and the number of filed wrong, but I'm guessing we filed close to $500 million in refunds at this point. I'm guessing that, I don't even know how many 941Xs that is, 10,000, and maybe more.
It feels like a million.
It feels like a million, I'm sure. We have had 0 qualify under supply chain. So am I on base there, Haley?
Yeah, I think 0.00 is right about right.
So I'm not saying the 13% of you that have had clients qualify that way are wrong. We just have not been able to see anybody that meets any requirements to qualify under supply chain. And from day one, we were pretty confident that it would be very difficult. I'll say from about day 30 after we analyzed things, it was very difficult to qualify under supply chain. There was just way more requirements than just I couldn't get materials, which is what everybody's trying to qualify under. So, all right, before we get to that, I just want to talk about partial suspension a little bit deeper, because I told you I'd talk about this more than nominal impact, because this nominal impact is getting misinformation on it as well. And so there's a way to qualify under the partial suspension rules if I can show that I had a portion of my business, and a portion isn't hey, 10% of my revenue was affected, so I'm good, or I had a 10% drop. That the 10% number, which is associated with the more than nominal, is I have to look at the business operations of my business. I have distinct silos, let's say, of business operation, and one of those silos was under a government mandate, even if the other 4 weren't, let's say. And if that silo was more than 10% of my 2019 revenue, then I can, and it was under a government mandate that restricted it, then I can show that I have met the more than nominal impact. Real life example, and I've used this before, it's been a year since I've done ERC, but if you've been on them, you've heard this example. I'm part owner of a bar in Chicago. It's a bar and a liquor store in Chicago. The bar was under restrictions from March 17th of 2020 until June 11th of 21. The liquor store was under no restrictions because obviously alcohol was an essential business. And because of that, liquor store, now it's the same building, it's the same business, it's the same federal ID number, but I can segment that out in the business. We have the bar side, we have the liquor store side. The bar side was under a government mandate for well over a year. Even though the liquor store wasn't under mandate, the entire business qualifies because bar was more than 10% of my 2019 revenue. That's the more than nominal. This information or the confusion that happens on more than nominal, I sound like I'm bitter or something, but there's just so much misinformation out there, and it's so frustrating to look at this and say you're completely analyzing that wrong, that we just want to make sure you understand that. So that's the more than nominal impact. That is a qualification. I'm going to stop on partial suspension. Now, the star of the show, we're going to get into supply chain issues, and I'm going to hand it over to Haley in a second. But before that, I just want to let you know, in IRS's initial notice, or one of the initial notices, this might be the first one actually, but 2120, they talked about how a business can qualify if their suppliers were under a government mandate and that affected them. And so that's why this information got out there that yes, supply chain issues can qualify you. Technically it can, but when we dig deeper into it, it is very difficult, one, to prove, and two, to actually fall in the scenarios that the IRS has spelled out. And so IRS recently in AM 2023-005 laid out 5 scenarios on supply chain, and I guess spoiler alert, in every case they say this won't qualify. So Haley, you want to go through these individually and then maybe a real life example if we got any?
Yeah, absolutely. So like Randy said, there was 5 scenarios that were laid out in this memo. Fortunately, Tri-Merit has been arguing in agreement with the memo since the beginning. And I think that a lot of these ERC mills are taking the words that were in that initial memo, the 21-20, and twisting the words or leaving out some of the important verbiage there. So going through, I'm going to go through each of the scenarios that's listed, talk about the conclusion and ultimate findings that were listed in that memo, and provide some examples. So the first 3 scenarios I'm going to go through all kind of together, and then talk about an example from that because they all kind of relate together. It's usually an argument that we see grouped, or the facts and circumstances of each of the businesses are kind of grouped together. So first scenario here talks about if a company had enough supplies to continue operations, then that is not a sufficient enough impact to qualify for the ERC credit. So if they had enough supplies to continue that operations, they do not qualify as a supply chain shutdown. Additionally, it also hinted that the business was not able to find a government mandate, and the port or supplier was not able to find a specific mandate that shut down that supplier as well. So if the supplier does not have a specific government mandate that they can point to say, hey, we were shut down during this time, that also does not qualify for the credit. So then scenario 2, it talks about goods being stuck at a port is not a qualification. Obviously, we know that there was a lot of goods and raw materials, products that were stuck in the port even after those ports were opened up. But the actual port shutdowns, the thing that this memo talks about the most is the port and the timing of the actual shutdown of the port. We've done extensive research into all different ports on both the West Coast, East Coast, in Texas as well, and we have not been able to find a long mandate. I think the furthest we've been able to find is about 2 weeks on a port shutdown. The rest is just delays from that, which is actually scenario 3, which it talks about the actual delays of ports after the government orders were lifted. So the only time you can qualify on a port delay would be the time that the port was actually shut down. So obviously it took some, a couple months for the ports to get caught up, if not longer than that, and getting out the deliveries and shipments that they had sitting at their ports. Unfortunately, you can only qualify during the port shutdowns were present with the actual government mandates there. So just to give a quick example of this, we recently had a potential ERC client that we actually thought was going to qualify for the credit just based on their facts and circumstances of their business. They had a unique situation. But these first 3 scenarios were things that they brought up to us. And this memo, specifically states that they do not qualify. So they specifically told us that they had enough product to continue operations. And I think that they only ran out of product, a few weeks before they were able to get their next shipment. So they were really didn't have any impact as far as the product that they were waiting on the shipment for. And then additionally, because of that port being shut down, it caused delays, and the product actually got stuck at the port because of those delays, and then was even delayed further in getting out to them. So again, just an example of exactly how these memos relate to specific clients. Again, those 3 things are usually what people come to us for the most. The next 2 scenarios, I'll group those together as well, because this is another thing that we did a lot. I think scenario 4 here is probably the first thing that I ask when I'm sent a supply chain argument, because it's the thing that these ERC emails are leaving out whenever they're talking about supply chain issues. And that's just, if you had an option to get the goods or the product, the same good or product or a comparable good or product, even if it was at a higher cost, that does not qualify your business for the ERC credit. Obviously, everyone, I think we all, I don't know if there's a business in the United States that didn't have the impact of raw goods fluctuation up mainly. So if that was the case, then every single business would qualify for this credit if we were able to take that into account, but we just aren't. If you're able to get the critical good at even if it's at a higher cost from a different supplier, that does not qualify you for the credit. So this kind of goes hand in hand with scenario 5 here. So scenario 5 talks about the ability to continue operating even if you weren't able to get the product that you were trying to acquire. So this one, I'm gonna go ahead and jump into an example of a client here. We had a client that was having difficulty grabbing or receiving chicken, was one of the products that was stuck at the ports. The chicken, they told us specifically that they could get chicken somewhere else. It was just at a higher cost. And it may have taken just a little bit longer to get that product, but they were able to go and find chicken to get somewhere else. Additionally, chicken was only a portion of the product that they were selling. And so they were able to continue operations even without that chicken being received to their facility. So again, these are the top 5 scenarios that we actually get every day whenever we're talking about the supply chain. So I'm, happy that it was clarified, but this shuts down, like Randy said earlier, almost every argument for supply chain. that's out there currently, and that's being utilized to kind of rope businesses into taking the credit when they probably shouldn't be.
Yeah, and the quote here, you know, that the inability to obtain the supplier's goods and materials cause a full or partial suspension of the employer's business operations. That's one of the things that they stated they're looking for. So
Mhm.
if you're a retailer and you struggle to keep stock in some products, but you're able to stay open with others, fortunately, they're looking at that, and it's not going to be looked at favorably because of that line item that the IRS is looking for. Doesn't mean it's impossible, but just keeping that in mind, it's probably going to mostly apply to manufacturers who weren't able to get kind of raw material supplies for the
Mhm.
stuff that they were building. But again, we don't see a whole lot of that. We barely at all. The couple of cases where it might have been impacted, they were qualified under other grounds anyways. So it wasn't one of those things where, you know, we could have looked at um, the supply chain interruption as a qualifier. They had enough of impact in other places where it didn't even matter.
Mhm. I think the next slide, Randy, shows some non-qualifiers for supply chain. These are, again, the most used uh, options here. So suppliers having self-limit the production, reduced hours. So if they, had COVID outbreaks within their facilities, if the suppliers did that, unless there was a mandate in place that said, if you have a COVID outbreak above, X percentage, unfortunately that COVID outbreak is not a qualifying factor or a qualifying shutdown. And then the inability of suppliers to find employees. I think even still, there's a difficulty to find employees. And so unfortunately, again, that does not qualify. And then other factors during COVID, obviously there was a freeze in 2021 that caused a bunch of, delays and things that were coming out of Texas ports as well as Texas manufacturers, and then increases in demand. And even I've gotten this one a lot as well. It's not on the slide here, but if we have suppliers that were forced to switch over to generating PPE products, that's unfortunately not an accurate or a qualifying factor for the supply chain argument.
All right, while we stop there, I'm going to put up poll number 3, and then we'll have one more to go. So let's launch poll number 3, and that was awesome, Haley. Thank you. Poll number 3. Have you lost any clients due to disagreements on ERC qualifications? Now, I've been hearing this quite a bit lately from people when I'm out and about, traveling around the country quite often. And this conversation's come up a lot. Either I'm about to fire this client, even though they're a really good client because they're not listening to me on ERC, or we just can't continue. We're giving them a ultimatum. Either you reverse your ERC or we're not going to be able to do your work anymore. I'm hearing this quite a bit, and then just so wanted to see, whether you dropped them or they chose to go elsewhere because of disagreements with ERC. And so we're 88% of you participating yet in this. We're right just short of a minute, so I'm about to stop. We got the 90. That seems to be our magic number. So I'm going to end this poll and let you know that 11% of you have had that, which, I'm not surprised. I honestly think this actually may grow as things go, because there's a lot of money out there that clients do not want to part with, but they probably did not qualify for. So that's where, what Nick had mentioned before, and your requirement of basically validating this before you file a tax return, basically doing the IRS's, pre-audit is going to be important. So yeah, this poll's ended. 11% of you have unfortunately fallen into this scenario where you no longer can continue with the client because of disagreements on this. All right, so I want to go into another argument, and this argument, this is out there. A good friend of mine, Dan Choden, who you see at the bottom. Any of you that are on Twitter, I think Tri-Merit was probably one of, if not the top company out there doing webinars on ERC. Dan Choden was educating people on Twitter, and Dan, we're in agreement on pretty much everything. And so Dan put this basically, argument out there in magazine called Think Outside the Tax Box, where people were arguing that you qualify because of OSHA. And you can see the slides out here and why the OSHA rules do not qualify you. In fact, I think I even saw, did IRS address this, Nick? I thought I saw something recently.
They inside the article where they were talking about all the fraud going on, they did touch on the CDC stuff and how that's not a mandatory, you
Right.
know, nothing's been put in place that's mandatory unless the states go and adopt any of these types of government agencies recommendations as mandatory requirements. In that case, you can, but it's not, you can't just say, yeah, the CDC guidance is there, it qualifies.
Right. Nope. And what Nick's saying there, CDC guidance, not a qualifying factor. Same thing with OSHA guidance. It's guidance, it's not requirements. If your state adopted CDC guidance and made it a mandate, then that's where it can kick in. But nobody made any OSHA rules a mandate specifically like this, so, OSHA in general, I'm not going to go through this other than the fact that if your client is being told they qualify because OSHA says they have to keep their employees safe, that's not a qualifying factor. And so just be aware of that. I want to address this because we talked about supply chain, and supply chain technically can qualify technically, but reality are different. In reality, as I said, we have not qualified anybody that way. I think we've analyzed these, in my opinion, obviously I'm probably biased, but I think Haley's done a better job at analyzing this than anybody else. And if we've not been able to find any supply chain that qualifies, I don't believe there's going to be very few that do. Now, in the same, basically the next paragraph in IRS Notice 2120, where they talk about supply chain can qualify you. Again, reality can, technically can, reality, very, very difficult. They specifically say customer-based suspensions do not qualify you. And so we're hearing some of this too, where your customer shut down, where you're able to qualify. That is specifically called out. The customer-based effect does not affect you for qualification of ERC. So just wanted to point that out. Same paragraph or next paragraph in that 2120, customer base effects do not qualify. Basically, what we're trying to tell you is things that your clients are hearing, we don't agree with. We believe IRS doesn't agree, because I think it's pretty straightforward what they do say there. And then another key thing when we're looking at this is and I mentioned this at the beginning, there's this whole just ignoring the fact that we have to analyze this with other credits and incentives. And so I don't know if either one of you want to expand on the whole ERC PPP interplay, other than the fact that we just have to make sure we, don't use the same dollars.
Yeah, there's not a ton to expand upon here. It's realistically, if on your application you put a wage amount, if that wage amount is over what the forgiveness amount was, well, the amount that's over that you can use towards ERC. If the amount of wages you put on there was exactly amount of the forgiveness amount, well, then you have to use those wages specifically for ERC. If you didn't put any other expenses, like if you had anything else that qualified for PPP forgiveness, but you didn't put on the PPP forgiveness application, you can't go and account for that in your calculation. You have to only take wages. That's the gist of it.
Yep. And then, interplay between, other incentives, same thing.
Same
Just
thing.
make
Yep.
sure you're looking at that together. This is important, the amending of the tax returns. We say, if you do agree with this, yes, we do have to go amend the tax return. You can amend the tax returns when you have done your due diligence and realize that this is a legitimate claim. And so the timing of that is important, because you want to make sure you keep your client out of any kind of penalty situation. Now, we've been doing this for 2.5 years now. We've been working on this, so if somebody claimed an ERC legitimate claim, for, let's say 2021, and they did that, last week, it probably makes sense to go amend that 21 return right now, because IRS is saying, hey, as long as you use good judgment and amend that tax return timely, then we're not going to penalize you. So they specifically came out and notice 2149. And then there was an additional notice too, where they said, hey, just be cool about this. Just come and tell us that you took an ERC. It's a legitimate one. Amend your tax return. Some of the problems with this though, is some of these refunds are huge. And what happens when your client's getting $2 million in refunds and they don't have the, $500,000 to pay the tax when you're amending the tax return? I still say this is our opinion. This is just how we're looking at it, is still amend that return now, even if you can't pay it. Set up an installment agreement. Hopefully by the time the installment agreement gets all accepted, you've got the refunds and you can pay that additional tax that's due. But the key is IRS is saying, tell us about it. Don't wait till you get the refunds, is what I read between the lines, because if you've done that, you've probably waited longer than the IRS expects you to do. Either of you have any comments on that one?
No, but there was a question in the chat here, just about what do you do if your client's refusing to go back and amend those returns? So I figured that was a question for you guys to answer.
I'm going to pass it to Nick. Oh, I can answer.
Yeah, I don't know that you want to advise one way or another, but that's kind of one of those things where you're disclosing the client, you need to make an adjustment on the returns. I mean, are you going to make it in the current year adjustment? Or are you going to make it, or are you going to tell them it's not a choice and I can't amend the returns if this isn't, or I can't handle the returns if this isn't made?
I think that's kind of what IRS is saying. You know that this 21 tax return has incorrect expense numbers on it. They're actually overstated, and then you're going to make this adjustment on 2022's return when they receive the refunds. They're not going to want that. That's just not following the guidance. And so if they're refusing, I think you're stuck in that situation where this is a client you may have to part ways with. I mean, unfortunate, or you just have to tell them that there's no way you're not going to do that. You have to amend that return, because this is there's nothing that says that you could point to that says, I'm just going to wait till I get the money. Now, reality is it's a timing issue. They're still going to pay the full tax and everything, assuming, again, same tax brackets from year to year and all that as well. But in reality, you may pay the tax the exact same time, whether you put it on the 22 or the 21 return. And very well timing could be the same, but that's just not what the IRS is asking. That's not what they want. And you're putting yourself and your client in potential penalty situations by doing that. Because IRS is saying, if you do it legit, if you do it right, if you follow what we're saying here, gave us a letter, say, hey, we're asking you to abate any penalty, and we're going to point to a 2149. They're saying that they're going to do that. So without following this, you're putting, everybody at risk of penalties. All right. And then the one thing that you hear as well on these, claims of, hey, get the money now, this is going to run out, from a timing standpoint, we're getting closer, but the first deadline to file 2020 ERCs doesn't run out until April 15th, or whatever the due date is in April of 24. I assume it's the 15th, unless that's a weekend or a holiday. April 15th of 24. Every quarter from 2020 is considered filed April 15th of the year after the tax year. So they're all considered filed April 15th of 21. So our 3-year statute in that to amend those returns is April 15th for all quarters of 24. Same thing with 21. We have till April 15th of 25 to amend all the quarters of 21 that qualify. So if you have high pressure, hey, do it now because this is going to disappear, we're not going to be able to do this right now. This is the case. That being said, there has been a little push to, should we cut this off short with the IRS? Some people have promoted that, yes, maybe we should just end the program now because of all the fraud out there. So there's a little bit back and forth. I assume if they do that, we'll know a little bit ahead of time, but maybe not enough to file these. I don't know if that's going to happen. Just be aware, I told you these deadlines, be aware that I don't think it's technically a proposal, but somebody has submitted that, yes, we should consider this. And Nick, I know you had a lot more information on that. Do you know where that came from?
Yes, this came directly from the IRS's article. So, you know, this is straight from their mouth that they are working with Congress to address the fraud and error. And sounds like if they can't find any other way to do it, they maybe want to try to push for that to come to an end. Now, again, that's the IRS pushing for it with Congress. What's going to actually come of that, we don't know. It's just we wanted to bring it to light that the IRS is trying to talk to Congress about that.
Yep. And one thing I want to address, I'm going to put the last poll up, and while I have this poll up, I want to address something, but poll 4 is now technically launched. Have any of your clients returned their ERC refunds? I'm just curious if you're seeing any of that, because this is that new service that we're looking at where we're going to be helping people return it if they legitimately do not qualify, if we can't find anything that supports the IRS's stance on this. This is something we're looking at, and there's a decent amount of you that have had this so far. I won't, no spoiler alerts yet. I'll let you know in a second. But one thing I wanted to point out is I have no idea. I completely forgot what I wanted to point out. But that's fine.
Is it Monday?
I have no clue. Monday's the conference, so that's, if that's what you're asking, it's Monday because my mind is all over conference.
It's already there. Yeah.
Yeah, we are. We're very excited about this conference, and that's a good thing to point out while this last poll is up. Honestly, this conference is gonna be awesome. Just go look at the website. Sorry to do a little push on this, but man, it's gonna be a good time. We've got a great speakers there. All right, I'm gonna end this poll. 15% of you have had clients that have returned refunds. So, that's a decent amount so far. If we're looking at the total dollars involved in this program so far, and if 15% are not legitimate, and I'm guessing it's even higher than that, there's a lot of issues going on out there. So thank you for that information some of you have already done that. And with that being said, I was going to wrap it up. I don't think you have all these slides. I'm not sure there's a lot more, but I don't know.
Go to the next slide, one more, because I think we talk about kind of
this one.
Keep going. So as far as timing of amendments, what the IRS has said is that they are caught up on 99% of open claims that are over 3 months old. That's what they've stated.
Mhm.
We think PEOs are not necessarily a part of that, because what we've seen is a lot of the older ones that are out there are clients that we worked with who were utilizing PEO. And it makes sense. I mean, the PEO claims are for hundreds of clients at a time, thousands even. So the IRS is taking their time with some of those PEO amendments. The PEOs are making sure that they're doing their due diligence. They're asking for more information from your clients, working with those. Just be prepared, for the situations you do need to work with it. But for a normal filing for a 941, right now, if it's a smaller claim somewhere under, a couple 100,000 or so, they've actually have sped up a lot. It's somewhere between 3 to 6 months we're seeing processing. If it's a larger claim, it still could be closer to a year, but even those have sped up, and we've seen some of those as quickly as 6 months, 6 to 9 months.
All right. One thing, let me address a few things that came through the chat. I noticed a few people saying they didn't see the polls. Hopefully you were on at the beginning where I said, if you're going through the website for Zoom, your pop-up blocker very well is blocking the polls. So hopefully you put in the chat or the Q&A that the answers, but we saw that you said you couldn't see, so we know you were there. So we'll get that out to you. A few people asked about the slides, and at the beginning I said the slides will be mailed out next week with your CP certificates, so everybody will get the slides as well. And then someone asked about our fees for analyzing filed ERCs. What we're doing is we're doing basically a flat fee of what is it, $1,750 to do the whole analysis, $1,750. We're assuming 5 hours at $350 an hour to do the analysis, and then based on the decision tree that goes next, there could be some additional fees if we're getting them more credit, if we're adjusting their credit. If it's pretty much just you would need to return this, that's all included in the base fee, correct, Nick and Haley?
Correct.
Yep. So the problem is the issue is the IRS, the client paid client money to get this refund. It's not legit. They paid that. they're going to have to fight to get that feedback. They very well might not get that back. Now they're going to be out a little more, but for you, the peace of mind to understand that, yes, this is a legitimate claim, or no, it's not, is probably going to be very important, because you already saw your decision of amending these returns are based on your thoughts for this. So just let you know it's out there. If anybody has any more questions, they can reach out to that. I want to thank everybody for being on today. I want to thank the top 0.1% knowledge base that we have on here with Nick and Haley. They know more about ERC than anybody in this country. I used to think I did, but they surpassed me for sure. And so any questions anybody has, reach out, and we really, really appreciate you getting on today's webinar.